Ryan, great to have you with us. Now, you've done a lot of data crunching on the correlation between the US presidential elections vis-a-vis the equity market, how things have played out in the past. Historical data actually shows October to be the worst month during an election year. But this time around, at least, it's a little different so far. So what should the strategy be then, Ryan, at a time like this? Buy, hold, or sell?
Well, first off, yeah, thank you for having me. But you're right. Historically, at least when you look at the S&P during an election year, October is the worst month of the year. Now, the S&P is up like 5% or so for the month as the time we're recording this. So clearly it's kind of laughed at that so far. But bigger picture, we can get into the election and all the ramifications of that. The US economy, in our view, is improving. Okay. I mean, I know that the employment data continues to be on the weak side, but manufacturing and services, different parts are really opening up. So whoever wins this election, in all likelihood, is going to have the keys to a really decent economy, maybe even improving economy. And when you consider that, what does the book tell us? Well, usually after the election, November and December of an election year, tends to be pretty strong once the uncertainty of the election is removed. And that's not something we want to avoid. And we think any weakness, we had that about 10% correction in the S&P a couple weeks ago, 15, 20% on some of the big cap tech names. And look what's happened. They've come roaring back just as quickly. And, we would think more any weakness or pullback could be just that, another buying opportunity for higher prices into the future.
So, Ryan, can market performance predict who will win in November? Is there any data to support that?
Well, yes. The short answer is historically there is some type of a correlation with the S&P 500. If it's up 3 months before the election, the incumbent party tends to win. And if it's down 3 months before the election, the incumbent party tends to lose. It's been right 20 out of 23 times going back to the Great Depression. That's an 87% win rate. Also, stocks recently were up about 7% during that time frame. If you start on August 3rd, we've never had an incumbent president lose the election when stocks are up that much. Now, there's still time to go. Let's be very clear. And 2020 is obviously a much different scenario than just about any other year with the pandemic we're dealing with. But our base case is, things might be a little bit closer than what some of the polls are telling us. It doesn't blindly mean President Trump is going to win. We see the polls. It definitely says Joe Biden is in the lead. But we think maybe things are closer. Also, historically, the U.S. dollar, if the U.S. dollar is kind of weak ahead of the election, that supports, again, the incumbent president. You look at wage growth. There's been some wage growth this year. Sure, a lot of that's because of the CARES Act, government literally sending people money. That tends to be a tailwind for the incumbent president as well. Also, GDP, we have a big surge in the third quarter. We'll get that number here in a couple of weeks. All four of those would suggest this race, in our opinion, is probably much, much closer than what the polls and what some of the what we're hearing about consistently in our view.
Sure. Ryan, let's look at possibilities now. How has the market traditionally been whenever there is an incumbent president who's come to power?
Yeah, stocks do much better. If you look at the year after the election, if the incumbent party wins or the incumbent president, I guess specifically the incumbent president wins, you tend to see about double the returns than if a new party takes over. And, maybe you could argue it's a relatively small sample size. At the same time, we know what we're going to get with President Trump, right? Whether you like him or you don't, you know what you're going to get. If we get new leadership in Washington, if you get the blue wave that we're hearing about with maybe higher taxes, more deregulation, there are some positives also to what Joe Biden wants to do, but a lot of people are worried about those two things specifically. So that could cause a little bit of near rockiness, if you will. At the same time, let's not forget 2016, right? We obviously had the red wave, then new leadership. What happened? The S&P went up a record 15 months in a row, and that's because the economy was improving. So at the end of the day, we can break all these things down: presidential, the president, Congress, all these things. If the economy's in pretty good shape, that matters more for investors and for the stock market than honestly what any makeup in Washington.
Sure. Ryan, the dollar index has stabilized around 94 thereabouts. How has it helped in predicting previous election results?
Yeah, well, similar to what I kind of built on a second ago, if the dollar is weak, that's kind of a calming market. We saw what happened in March when everything got really scary. U.S. dollar soared higher. It's kind of that risk-off trade, if you will. And historically speaking, 7 of the last 8 elections, the U.S. dollar's been right. What I mean by that is 3 months before, if it's down, the incumbent party wins. 3 months before, if the dollar's up, the incumbent party tends to lose. And the dollar had that big spike a couple weeks ago. It's come back down, and dollar is lower now than where it was on August 3rd, and that's the magical date we start because that's 3 months before the U.S. election. So something to be aware of. Now, the other side of this, if you look at Joe Biden's policies, we do think Joe Biden's policies probably are a little bit more of a weak dollar policy, whereas maybe some of President Trump's policies be a little bit more of a stronger dollar policy. So then you have to ask yourself, is the market forecasting potentially a Joe Biden victory? And the dollar is kind of weak in front of that. I mean, I guess we'll have to wait till November 3rd to see. But the bottom line is a strong stock market, increasing wages, better GDP, and a weak dollar all historically have been more of a tailwind for the incumbent president to potentially win re-election. And that's clearly what we're seeing right now.
How will the earnings get impacted in case there is a corporate tax increase, Ryan?
Yeah, well, I mean, there's no doubt earnings will take a hit. I mean, if he goes from 21% to 28%, we're estimating the hit on GDP, not sorry, or the hit on S&P 500 earnings next year might be about 10% or so. So a decent hit. But the other thing, though, is, in all likelihood, he's going to probably remove some of the tariffs, maybe even all the tariffs we have with China. He's going to make some better, potentially easier trade deals with Europe. So that can actually increase, if you will, some earnings that unlock some earnings there. So it's not just so simple as higher taxes are bad. There's a lot of spending that's going to come in. We're looking at probably a huge infrastructure plan with Joe Biden should he win. And that could be a tailwind. Also, a lot of spending on green energy. So, what is the stock market like? The stock market likes spending. Okay, whether you agree with it or you don't. President Trump has spent a lot. Joe Biden spent a lot. So that tends to be a positive. So a little bit of a hit on earnings, but there are some positives under the surface. We think that just a big worry about higher taxes and more deregulation, what we hear in the headlines. If you look under the surface, some of the things Joe Biden's potentially going to do could kind of make up for some of the negatives on the higher taxes that we potentially could see on the corporate side of things here.
Right. The market, Ryan, has been rather myopic in its view and only anticipating when the stimulus package is going to come out. How do you think the stimulus package, though, is going to impact the election verdict?
Yeah, I mean, the truth is, I think the market is realizing we're going to have to wait till after the election for the stimulus package. If you look at how much fiscal stimulus the United States has done as a percent of GDP, it's like 12% of GDP. A lot of other developed countries have done a lot more. But we're looking at probably, a $2 trillion give or take deal, likely after the election. So the stock market is a forward-looking mechanism. It can hold tight here for another month or month and a half or so, but likely after the election, whichever side wins, we know there's going to be another stimulus. I mean, everybody agrees we need one. It's just kind of how do you make it? How soon do you do it? And how large do you do it? Obviously, I mean, President Trump had a tweet just yesterday talking about go big or go home in terms of how big the stimulus should be. So that's his opinion. You got to get the other Republicans in Congress to agree with that. But the market is okay with waiting, say another month and a half or so to get past the election, knowing that big stimulus plan is likely there. And one more quick thing on that. The economic data overall has still been pretty positive. This earnings season should be pretty strong. We expect earnings come in, good deal better than expected, led by technology and led by healthcare, the two all-star groups that continue to do really well. So we've got a little bit of time here, but the market is anticipating it. So, it better, there likely will be a stimulus plan, and market will probably like that here sometime after the election.
Sure. In the current context, though, Ryan, how is it that you're gauging the emerging market move?
Yeah, we've liked at LPL Research. We've liked emerging markets for a while. I mentioned the U.S. dollar. We think we've got with the huge deficits, trade deficit, budget deficit, a lower trending dollar, which is more of a tailwind, if you will, for emerging markets. But we like the Asian emerging markets more so than the Central American emerging markets. We just think, some of the data is better out of there. Obviously, with COVID, it started there first. Whether you believe the Chinese data or not, the Chinese data has been really strong. So we like emerging markets, but would focus more in Asia on the emerging market side of things. And let's not forget earnings. I mean, there's some good amount of the earnings are improving quickly in emerging markets. And next year in 2021, we're looking at very explosive, up over 20% earnings growth in emerging markets in general. So that's a group that we think from a diversified portfolio, from an American investor point of view, makes sense. But anyone around the globe, they probably want to add some emerging markets to their portfolios here.
Sure. Okay, I'm just going to quickly take stock. But before we end, Ryan, just wanted India-specific view. If you've taken the look at the charts of Nifty as well as Sensex, and what has been your reading on what the road forward is looking like? As we speak, the Nifty is already hovering very close to its year highs and almost breaking positive for the year.
Yeah, overall, they still look really good to us. I mean, we don't necessarily in the models that we run have any exposure with outside of the broad emerging markets. But there's still that potential there. We talked about the earnings growth, and obviously COVID has slowed things down, but some of the manufacturing is coming back. So overall, that's definitely an area that we still think there can be some opportunity in.